Thanks so much for tuning in to BQ Conversations. This is as important a conversation as we can have with Sean Darby. He's Chief Global Equity Strategist at Jefferies, and he joins us to talk about how he sees risk assets in general and equities in particular in light of what's happened yesterday. Sean, good having you. Thanks for joining in. Understand it would have been a very busy day for you. Thank you for taking the time out. What do you make of what's happened in the last 12 hours?
Well, I think human beings tend to like linear moves or linear changes in data, and unfortunately, the CPI numbers were nowhere near as good as people had expected. And the paradox at the moment is that people actually want bad economic data, which hopefully then transforms itself into poor CPI data, thereby ensuring that the Fed is not going to tighten too much. Unfortunately, we're getting quite good macro data, but again, CPI that is not necessarily rolling over as quickly as expected. Hence, rate assumptions keep being pushed upwards. And I think that's really what the last sort of 12 to 14 hours have really sort of reflected.
So how alarming or how worrying, if at all, is that coupled with the whole geopolitical stress and the QT around us, wherein we know that if not in the next 3 months and next 6 months, arguably for the next 12 months, inflation will be lower than where it is right now?
Well, I think we generally can accept that inflation is on a somewhat downward slope. Unfortunately, the rate of change is not what people had anticipated. The worry for markets is that everything comes with a lag. So it's hard to know that this type of tightening or the rate of change of tightening won't be more harmful for the economy sort of 6 months down the road. And the work that we've done shows that, for example, the ISM manufacturing is actually really heavily influenced 18 months from the point of rates being sort of adjusted. So these lag effects can mean that you can make a policy over tightening or a monetary error, and therefore only find out about it 3 to 6 months afterwards. And I think that's what the markets are more fearful of at the moment, that there'll be an over tightening by the Federal Reserve as it tries to adjust to lagging data, which unfortunately is not necessarily going its way.
What would you have written in your strategy note this morning, Sean, considering that equities are nowhere near the lows that they were? And while India is where it is, but forget India, I mean, the global equities are not near their highs as well. So what is it that you've written in your note this morning?
So you're quite right. We're sort of, for equities, we're in no man's land. We're not finished with the tightening cycles, and we're not finished with the downward drift in global earnings. So unfortunately, there's not anything that the equity investor can really hold on to say either we're going to make new lows or that the worst is over and we're going to start to make new highs. I think this is what's causing this sort of, what I would say, it was probably a period of range-bound performance or consolidation, but we haven't really been able to admit it just yet. That's normally how it feels when you're going through a range cycle, that you cannot necessarily know those, the dynamics of the shifts between growth and tightening of policy.
Sean, how important a factor would be the withdrawal of liquidity, if you will, and QT in the overall scheme of things? Because nobody's quite out there in proclaiming the exact impact of what that could come out. Maybe it's difficult to do so, but I would love to understand how you think about it.
That's a really good question, because we've only looked at one of the tools that the Federal Reserve has, and this possibly one of the blunter tools. So if you look at it holistically, not only has the Fed got a mechanism to lift short rates, the dollar strength sort of also means a tightening in policy. So for every 10% move in the dollar, you tend to get implied rate hike of 50 to 75 basis points. And as well as that, you've also got the quantitative tightening that's just begun in the background. Now, the latter is probably not as fearful for markets in the first instance, because there's quite a large amount of excess reserves around. The danger would be if indeed the Federal Reserve was again over tightened and hadn't really got down to adjusting its balance sheet at the same time. I think the markets would look at that as being quite a significant policy mistake, because that was exactly what happened back in 2018 when Mr. Powell was doing the pivot, or had to do the pivot. The dollar was strong, in short interest rates were moving up, and of course we had the withdrawal liquidity, and you had to have a very, very quick reversal in policy, and that may be what we're setting ourselves up for sometime in 2023.
Okay, well, add to that mix what I heard somebody tell me, that the gas issue for Europe could be Europe's Lehman moment. Would you go that far?
I'm not necessarily sure that it will break the Eurozone system. I think we've come a long way from the sovereign crisis in 2011, where there was an existentialist crisis for the euro itself. It would seem that the fact that Germany is in the same difficulty as Greece and Italy means that there's more political palatability towards doing some fiscal backstop, and I think that's ultimately where we're going in this. In that it won't necessarily be price caps, but there'll be some form of subsidies going into the system. I think also that bear in mind that the banking system has enjoyed a particularly strong recuperation through the pandemic, and that profit cycle that we've had in Europe in the last 12 months has really rebuilt balance sheets. So I don't think necessarily we're going to suffer a Lehman-esque type of collapse, and certainly I don't think we'll suffer anything like the sovereign crisis from 2011. It's going to be very difficult for profits, but not necessarily one that undermines solvency.
And can geopolitics be a very large, impactful event as well, or right now it's not in the scheme of things?
It is. I think it's just very hard for investors to try to manage around that. I mean, we're going through a euphemistically new normal, and we're trying to find our feet between the politics between not only US and China, but also, of course, even within China itself, the relationship between the state and the private sector. So there's quite a lot of different moving parts. I guess the way that this all plays out, and probably is reflective of all of the symptoms that we've discussed, has really been the strength of the dollar, which is at its record high in trade weighted terms. And that tells you the combination of economic uncertainty and geopolitics is extremely uppermost in investor minds at the moment. So
net, all things considered, Sean, are you from a US equity markets perspective, are you constructive? Are you of the view that they might be sideways, or are you negative? And thereby the follow-on in effect, let's say on EMs, wherein the Indian viewers' interest comes in, how constructive or not constructive are you?
So I think we are constructive on US equities, mainly because we think it's a growth recession and not a credit one, and we would change our view if the latter was to occur, and that would be a policy over tightening. The one thing about the US is that it's a cleaner story. We know we're somewhere through at least half or 2/3 of the rate tightening cycle. So yes, it's not particularly pleasant looking at the screens at the moment and trying to work out the lag effects, but it's a lot easier in the respect of looking at, for example, Europe or the UK, which have got much more stagflationary environments. One thing we can certainly say in the US, it's not stagflation. Growth is trying to revive and inflation's coming down. I think for Asia and EM, it's been I think the positives to take away really is that with oil at times being over $100, a record strong dollar itself, a very, very subdued China economic cycle, Asia and the EM has actually performed relatively well. If you told me that we would have those three variables moving so adversely 12 months ago, I would have expected much more of a fallout, but that's not the case. So that sets Asia and EM up to be actually relatively good places to be, sometime in 2023.
Okay, last question. Any individual views on India?
Well, I think a lot of foreigners sold out perhaps too early, because they saw the amount of relative outperformance of India. That, in retrospect, now looks to have been a mistake. I think the good news for India is that it's going through a conventional cycle. You have had a steep yield curve. That's a nice environment to be raising rates. Remittances, which we think has been the perhaps the most under discussed positive for India, have been booming, plus 70 billion or so. And last but not least, that the dynamics for India in terms of geopolitics is actually it stands very well. So yes, market has looked quite expensive, but we would feel again that the cycle looks a lot more transparent in terms of dealing with the variables at the moment, and hence we still have a positive outlook towards Indian equities.
Much appreciate your time today, Sean. Thank you so much for speaking to us.
Thank you.
Sean, we'll leave you.